You know this is the right home for you, but will you get the right home loan? Let Property Guru's mortgage tools and experts get you from finding the right home to the right home financing to finally moving in. Property Guru will see you home.
To us first. Okay, so let's start. Maybe Ben. Okay. So a little bit about myself. This one tells me I need to lose weight. But my name is Paul. I actually have been in banking. That's my background. And I've been a real estate agent in the past. But essentially, my knowledge of where I work best is in the area of mortgage. And, I built businesses in mortgage for the banks, and I, guided and trained a lot of mortgage salespeople and mortgage business. So let's talk about Ben.
Okay, this is me. I'm Ben. Like Paul, I've also worked many years in banking. 1 year short of Paul. I work in all the 3 local banks. Basically, my forte is in mortgage loans and wealth management products. So we help a lot of customers to get the best home loan interest rates lah. So that's me, Paul.
Yeah, handsome as always.
Thanks to my mother and father.
Okay, let's move to the next one. Let's talk about interest rates. Now, this is the thing that has been the main reason behind why interest rates have been going up. Now, in the US, you look at inflation rates. If you look at the inflation rates, that's gone up quite a bit since 2020. And essentially, what the Federal Reserve has been trying to do is to raise rates to lower inflation. Inflation in a situation where the interest rates are high, basically it's more expensive to borrow. That's the first thing, obviously. And also you gain more when you put the money in the banks. So the idea is to pull cash or pull money out of the economy so that people will not spend as much. That's the whole idea, right? But as you can see, in the past few months, they've been increasing rates, but still it doesn't seem to be affecting the rates much. Although you see the rate of increase has slowed down significantly, but it's still very, very high now at 8.2%. Yeah. So essentially, higher interest rates pull money out of the economy, and hopefully inflation will drop. That's the idea. The numbers have been showing that to be weaker now recently, and there's talk that interest rates won't go up significantly anymore. But this is anybody's guess at this point in time. Next one. Next. Ben, sorry, before I forget, anything you want to add to this?
Yeah, I mean, the numbers looks like coming December, right, Paul, there'll be likely a moderate increase in Fed rate as well. That's what everybody's projecting. So here in Singapore, we will likely to see another change in the bank rates as well for home loans.
Now, we have to take note in Singapore, it's not like the US. There's no central bank to increase rates, or there's no party that says, I'm going to regulate the economy. In Singapore, how they manage interest rates is through the exchange rates. So if you notice, your exchange rate against the other seems to be quite strong. And that's why some of the increases in the US interest rates is discounted when it comes to Singapore. So you will not see a one-for-one increase. You will see a reduced impact on the Singapore interest rates. That's why you see, although rates are higher, it doesn't increase at the same pace, right? Maybe let's move over to the next slide.
Okay.
So this one is the interest rate. If you look at it, if you stack the charts over each other, you'll notice it kind of goes in line, right? The interest rates now have gone up. Recent one being 75 basis points. That's when they say basis points, it means 0.01. So 75 is 0.75 increase to 4 to 4.5%. I think essentially, in terms of interest rate outlooks, Ben will share with you later, but how that looks in Singapore, there won't be a direct translation over to Singapore. Yeah, Ben?
Yeah, correct. Looks like yeah, as I mentioned earlier, right? This one, there's no direct correlation step in step with the US side increasing rates. But looks like in 2023, right, we are going to have maintained at a high interest rate for home loans. That's something that we all homeowners need to be prepared for to pay higher for their home loans as well.
Not bad, not great news, but there are things that we can do, which is why we are talking about it today. Okay, let's move to the next one. Ben.
Yes. So this is the reference rate, SORA, right? Is a Singapore overnight average rates, which banks are mostly using to price housing loan. As you can see, right, 3-month SORA rate has a steep increase over the past actually few months. It was, I remember, Paul, it was January, not so long ago, right? It was 0.19. Today, it's already almost closing to 2.6% already. So for those people who have gotten their home loan early this year, congratulations. But right now, yes, we have to deal with a higher interest rate. There's a reality right now. And you know, Paul, right, in Singapore, I think for the last a decade, possibly, we are not used or accustomed to high interest rates such as this. But there are ways to mitigate paying extra for our home loans. We are all homeowners and we all have housing loan ourselves. But this 3-month SORA rate, most of them priced against 3-month SORA. Yes, it will have to pay more, definitely. But later we'll share how we can mitigate this and save money for all our clients.
So SORA rates are quite interesting, right? This one was a rate introduced, I think, and this rate is managed by the Monetary Authority of Singapore. So that's quite interesting because previous rates like SIBOR are managed by the Association of Banks, and that was a deliberate move. Firstly, secondly, how they do this is quite interesting because SORA is measured over the past 24 hours, right? And what they do is they will track all the transactions that go on in the market, aggregate, meaning total it, and then they average it. So this is the rate that's happened over the last 24 hours. Now, the other rate that later on Ben will talk about is called SIBOR, or the interbank offer rate, the Singapore interbank offer rate. That is actually a projection of rates, meaning the banks will look at it and say, well, I think that with this economy in the US, interest rates will be impacted. So everyone comes up with a quote within the committee. I think the Association of Banks, I think 22 banks or something like that. Now what they do is they divide it by 4, meaning they will rank all the rates. They will drop the top 25% or top quarter. They will drop the bottom quarter, leaving the middle band of 50%, and they average it all up. So you will see that one is firstly based on expectations, right? So if everyone thinks it's going to up by 2%, then you know the average will jump very, very fast. It's not based on actual transactions, which is good and bad. I mean, but mainly bad in my opinion, which is why Singapore has chosen to shift into SORA, right? So it's good that we're going on SORA. But yeah, I think it's important to understand what a lot of the loans are based on. Yeah. So Ben.
Okay. So a lot of us have seen, right, that due to the increase in Fed rate, it has hit home locally as well. We've seen fixed deposit rates, right, gone up substantially, very high, right? We're looking at even 3.8% fixed rates, right, for fixed deposit, which we have never seen for a long time, possibly even close to 20 years. And this, of course, being fixed deposit rate has gone up, right? Definitely, housing loan interest rate will also follow suit in tandem as well. As you can see on the screen, right? The multiplier account, which a lot of is very popular. It has even registered a 4.1% interest being paid out as well. This is something that depositors are lining up in banks, right, to queue up to place their fixed deposit. I think 2 months ago, they were lining up to queue up at 2.8%. Now 3%, they probably have to withdraw their money and put back in again. But that's a good thing, of course. But the bad thing is, of course, like I said, right, the interest rate for home loan will also increase in tandem. And looks like, yeah, this is something that and there's a lot of housing loan being pegged to fixed deposit rate in the past, right? It's not so popular now, but this is something that as the fixed deposit increase, right, for those customers that are in fixed deposit pegged interest rate for their home loan, right, you may need to relook at, how we can actually see whether there's a better option for you to mitigate the risk of increasing fixed deposit rate, which will affect your home loan.
Yeah, I mean, a lot of people want the deposit rates to go up, but they don't realize that these deposits are the ones that fund the mortgages. So if the cost of deposits go up, then certainly it must come back somewhere in the form of higher interest rates for loans. Yeah. But yeah, this is directionally where it's going. But let's see what we can do. So home loan strategies, right? I think one of the things that we want to share with the general public and our consumers, right? The fact that there are things that you can do to try and mitigate the interest rate increases. I think people are feeling very, very stuck and so on and so forth. I think the good thing is, in Singapore, they have what we call total debt servicing ratio that basically measures how much money one can borrow from the banks, right? And that is good because it protects us, but because of this measurement, right, and how the banks approve loans, there's a group of people what we call mortgage prisoners. So mortgage prisoners are people who basically take a loan somewhere, and they're stuck. Maybe their spouse has stopped working. Maybe the circumstances have changed. Maybe they've changed jobs, right? A lot of things have happened that cause them to be stuck in one bank, like a prisoner, right? So I think too many people are not talking about this group of customers. We've helped quite a lot of them. I mean, when they come to us, we in some cases, not all, we can help them to refinance or look at other options. Yeah, so we'll talk about that along the way. Ben.
Yeah, I've come across, Paul, right, like customers of ours that have seen their mortgage, right, increase by even $1,000 a month in installment. So I think it's important that we discuss this today, how we can help more people to lower down their interest rate costs. Okay, I'll go on the next slide. Okay. So yes, of course, when in Singapore, it's very common that we need to constantly check on our home loan to make sure that we are paying bottom dollar for our mortgage, right? So one of the strategy that we need to always look at is whether there's another bank that offers you something better, in that sense that it makes sense for you to go on a different package. So refinancing is one option that you can look at, right? And fixed rate is very popular in the sense that, especially now in an increasing interest rate trend, right? A lot of people are worried that interest rate will go even higher. So some opt to choose to hedge their position and choose a fixed rate that would not fluctuate. And even if the person previously, there's a lot of customers who are on SIBOR, and actually a lot of people in Singapore, right, who are still on this old reference rate of SIBOR, which will explain later what's the difference, which tends to be more have risk of fluctuation compared to SORA, which is a historical rate. So if one is on SIBOR, right, and you may want to check your letter offer, there's a good chance that you're paying much more than is what is necessary. So we can look at other options such as fixed interest rate, as well as possibly switching to SORA to lower down your interest rate costs. This is a very good option. And you have, if you're a homeowner, right, you possibly have heard that fixed rate has gone through multiple changes to higher interest rate tranche. So do talk to us what's available out there, right? So that we can actually help you to narrow down based on what is your preference, what is your financial objective, like how long you intend to keep your house, or whether it's an investment property or whether it's an owner occupied property. So looking at all your objectives, right, we're able to, come together and find what is the most suitable package for you.
Yeah, I think the standard at this point in time response I get from clients, and not all of them, is fixed rates are so high, right? I think what am I going to do, and so on and so forth. So really it depends on your personal expectation on the market. Now, some of the clients have come to me. I mean, I've got a few who are quite close to us who come and say, hey, I don't care that the rates are high, when I'm going to lock it in so that I can sleep at night, I think that's the first thing. They say, yeah, I may be paying the recent one, what's that? 3.85, is it?
For which one? For SIBOR, huh?
Fixed rate.
Oh, well, a few days ago, it was 3.5%. Right now, it has the current available one is 4.25%.
Wow. So a lot of people are saying, wow, it's so high, But end of the day, it's a question of perspective, right? Some people are saying 4.25 is low. Why? Because in foreign markets, a lot of the times interest rates are about 5%, 6% to as a start, right? And it's gone up to 8-9% depending on which country and so on and so forth. So relatively, it is low. That's the first thing. Secondly, if you go into that, you would lock in your rates for that period of time. Is it good? Is it bad? It really depends, If interest rates go up, the floating rates of SORA go up, and it hits 6%. I'm just saying, I'm not saying it will. Just give me an example. People are looking at it and say, yeah, I'm glad I locked in, But interest rates, if it falls to 2%, people will be saying, I shouldn't have locked in. So there are pros and cons, right? Depending on your risk appetite and your expectations. And of course, time horizon. Yeah.
So Paul, this part about fixed rate, right? I mean, like we mentioned, it has gone up to in the market right now, it's 4.25%. Yeah, there's a constant worry. Will I be fixing it too high? And what if interest rate comes down after that? Will I be stuck at a higher interest rate? So it is something that, well, in a way, there's no right or wrong answer, like what Paul has said. In foreign countries, like what Paul also has mentioned, right, is much higher the interest rate. It could be possibly 8% or so. So yes, I have a customer who is a foreigner say that, yeah, to him, right, this 4.25 is actually very cheap, in his opinion.
Yeah, and we've been enjoying low interest rates for Ben says 10 years now. Actually, that shows Ben is quite young. No, I've seen something like 20 odd years now. Ever since I entered the mortgage business, right, in the banks, this is the highest time that it's gone. Of course, it's gone higher in the past, but that's like 20 years now, you've seen the highest period. But guess what? When you buy a property, it's for 25, 30 years, and it's not going to be high all the time. It's going to go up and down. Yeah. So let's be optimistic. Interest rates will go down. The question is when, right?
Okay, on that part, right, I've seen this 4% fixed rate in 2003. So it's almost 20 years and we arrived back at the same point. But the question is that will it go higher? Yeah,
and for how long, right? So yeah, even at 1.8% fixed, I had clients, and you and I shared the client, right? Who said, oh, I never benefited from the fixed rate because the interest rates dropped significantly. So the trick is to apply your strategy and to be optimistic. Yeah, maybe let's look at the next point.
Okay. Yeah, Paul, would you go on this copy?
You can talk about it.
Sure. Okay, so recently with the cooling measure that has been introduced on 30th of September, right? The MAS the authorities have actually increased the stress test of qualification for a loan, right? From 3.5% to 4% for residential property, and for commercial loans from 4.5 to 5%, basically a 0.5% increase. Now, this is, of course, a prudent measure to ensure that when the person wants to take up a mortgage loan, right, he is able to withstand a higher interest rate in that extent, should interest rate go up. Now, in this current moment, right, as we mentioned earlier, fixed rate has currently the bank is offering 4.25% fixed rate. So this benchmark of 4% is below what is being offered on a fixed rate by certain banks out there. Now, of course, that brings a question whereby, in a sense that, is this stress test now realistic? Because the current interest rate is going up higher, possibly higher than the stress test interest rate that is at the moment is 4%.
Yeah, I know of some banks who are actually using higher than 4%. They're using 4.5. And this is the situation before 2013. Actually, banks had been using different interest rates to compute home loans. And the part of the reason why the TDS or MAS 645, which is the name of a regulation, was introduced was to standardize these rates. Otherwise, clients will end up shopping between bank A, B, C, D, E, right? I look at it, I will go for the cheapest rate that they use to compute because I can borrow more, it means. Now, what this suggests is that if the same thinking is going to be applied, meaning there's an intention by the regulators to standardize the rates, what this could mean is that the rates could move up, right? So for those of us who are planning to buy a property, buy quickly. At this point in time, if you're looking for something, you need to buy a property to live in, you're getting married, or there are circumstances within your life which demands that you buy a new property. Time to do it is now, and do it quick, right? Before any possible changes come. I'm just saying that it could. I'm not saying it will. Okay. Yeah. So that's something that to bear in mind. Yeah. Yeah. Next one, Ben. CPF. Now, I have a question. I think we have a question actually from somebody who asked, right? Is it advisable to use CPF ordinary account to pay off my loan, right? And then the answer is, should you or should you not do it? End of the day, right, there are a couple of points that one needs to take note of. Firstly, cash flow. So if you need to use your funds to service the monthly installment, you look at how much cash is coming in and so forth. You know that when you use CPF, right, you are actually managing the cash flow, how much cash you have to use to service your loan. Now, if your cash flow is under stress, then it may not make sense to use CPF lump sums. Lump sums to sorry, a bit my screen went a bit wonky. If you look at I lost my train of thought.
A CPF for lump sum payment.
Yeah, CPF for lump sum payment, right? So if you use that, right, then your monthly cash flow will be challenged or could be challenged, right? So really it depends on what is. The other thing is interest rates, right? Now, if I'm telling you, right, your interest rates are 5% on your home loan or whatever, the higher, significantly higher, and CPF right now, let's say, continues to pay you at 2.5%, then it makes sense to do that to minimize interest costs, right? So really it depends on what your objectives are, right? That is something that is on a case-by-case basis. We don't recommend, or we don't go out and tell people this is something that you must do, and so on and so forth, right? We look at circumstances. I mean, I had a case where a customer had high interest rates, or rather she came in and she said, I don't like high interest rates. I don't like interest rates. I don't like interest. Please give me the cheapest loan, the shortest period, the smallest loan. That was the objective. But, that was years ago when I was in banking. I had this conversation with her and I realized this lady was a single lady. So no dual income, no alternative sources of income except through her work. Now she was working in a MNC, very confident in her job, right? So that was a scenario. But I worked out the numbers and said, look, if you have a strategy of managing your partial payments and using product features, you can manage down your interest rates without bearing the highest costs, right? Without bearing so much interest costs. So thankfully she did it. 6 months later, she came to me and back to the bank, right, to look for me. And usually when people come to me after it's to complain lah. But in this case, she said thank you very much, because 3 months after she finished the transaction, she got retrenched. And so she was wondering, she said, if I had not listened to you, end of the day, I don't have CPF balance, I have no cash. Because remember, she was very, very against holding debt and very against holding, she wanted to clear up her cash and CPF, right? Then she said that she would be under financial distress. So really it's case by case on your personal circumstances. And on that, right, I wanted to address this before we go on. Fine. Somebody disagreed the suggestion to buy properties now, right? So really depends. I think we are speculating what may happen. Increase interest rates, property price will drop. I don't disagree. I think it's a case of demand and supply. But one of the things that we did say is that if you need to buy a property now, because at any point in time there'll be a group of people who need to acquire the property, right? Perhaps a family is forming, kids are coming, whatever, right? We say, look at that. We're not encouraging you to do it. We're just saying, look at your circumstances. If you need to, this is the time to do it, right? So, yeah, I'm just addressing it upfront in case some of you are wondering, hey, is PropertyGuru Finance saying that we must go and buy? Answer is no. Depending on your own circumstances, if you are looking to buy, this is the time to do it in case the regulations change. I hope that's clear. Okay, Ben, over to you, Ben.
Okay, so there are some questions coming in. We'll do our best to answer all of them or most of them, right? On the question whether it's advisable to use CPF to pay off the loan, right? And the person is a retiree. I would say that do buffer for if you use up all your CPF to pay for the loan and fully pay off, right? Then as we get older, right, it's very hard to have immobile property and cash is more important in that sense. You may use some of the CPF to pay down the loan, but to totally pay off the loan, and I have a lot of customers who are retired and come back to me and say that, can I take out a loan from my property? The answer is yes, but it gets more difficult as we age, right? And the bank actually do consider income as well as the age factor when they want to lend back money for a fully paid up property. So I would say that for me, right, if you're a retiree, right, you can use some of the CPF, but if you have a loan, right, do keep some of the loan balance. Don't have to pay off in full. But I do get the idea that now interest rate is higher than what CPF ordinary account is paying. It is, you can, as what the slides mentioned here, you can actually use CPF to actually pay off either lump sum or do CPF monthly servicing as well instead of cash.
Yeah.
Okay.
Yeah.
So I hope that answers the question on whether it makes sense to use CPF to pay the loan. Yes, it makes sense because it is very obvious that the CPF OA is paying you 2.5% and the interest rate is much higher than that. Okay.
Yeah. In fact, somebody asked, should they use cash to pay down? I think the same points apply, right? If it's spare cash, go ahead and pay it down. If it's something that you need to, some people or most people will have a lump sum of funds, right? That is really excess funds sitting around doing nothing. Then it may make sense to do that. But please don't use your initial funds, your backup funds, the funds that you need to pay off, because then you lock up your funds and end of the day, you could get into trouble on a daily basis. Let's move on, Ben.
Okay. Now, this part here, of course, some customers, right, they actually do have several properties under their ownership. They have perhaps husband has one house and the wife has another house, and they also possess a commercial property as well. Now, as you know, right, there is a possibility that we are really not sure, right? We don't have a crystal ball that tells us that when will the interest rate comes down and how high will it go and things like that. So right now, if you have multiple properties, right, it's possibility that you can do a fixed rate for some of the properties that you own, and also choose variable interest rate for those that perhaps that you want it to be on a variable so that you have a balanced portfolio in that sense, right? I would say that if you have an investment property that you're collecting rental, right, it may make sense that you actually do a fixed rate so that you can hedge your costs in the sense that your rental can cover the installment as well as cover the maintenance and sinking fund. So you are protected in the sense that if interest rate goes higher, you will not be in a position whereby you have to fork out extra money, right, on top of the rental to pay the loan. Or if you have a commercial property that, as you know, commercial property has higher interest rate in general than compared to housing loan, right? And there's a lot of business owners, right? They are so busy with the business and day-to-day operation, they actually forgot that their interest rate has run up very high, right? And this is something that we can actually help to advise based on their multiple property portfolio, right? Which one, based on their balance, based on their objective of the customer, which is possibly can go into fixed rate, which possibly can take up variable rate, and which is also possibly to use cash to pay down and things like that, right? So it's something that we can actually, we do help a lot of customers with this, but we do firstly try to understand what is the customer objective of the ownership of the property before we actually give any advice.
Yeah. Again, this is not something that say, guys, go and do 1, 2, 3. We would never do that without understanding. It's like playing Tetris. We have to look at whatever the circumstances are before we suggest what to do. Okay.
Let's move on to the next slide. Okay. Yeah. This one, as I mentioned, right, SIBOR has gone up to a very high level. It is the reference rate of SIBOR, right, compared to SORA, it's almost 1% extra than SORA. So if you have not changed to a SORA pack home loan, right, you could possibly be paying around 5% on your home loan. SIBOR was all the while, right, is the benchmark rate until SORA was introduced lately. So in this case, a lot of customers, especially commercial properties, are still on SIBOR. And if you have a commercial property loan, right, some of them could even be on the board rate of the banks, right? And I've seen interest rate as high as 6%, over 6%. Even if you switch to a fixed rate of 4%, right, you actually save 2% in that sense. And it's really a good opportunity to take a look at what you currently have, right? To take stock and talk to us, talk to me and Paul. We can actually help you to make sense of what's the best option, working with your objective as well.
Yeah, the thing is, some clients say, I'm happy with SIBOR, right? And then no point moving and stuff like that. Now, remember I said that SIBOR is managed by Association of Banks, and SORA is managed by MAS, right? Or the Monetary Authority of Singapore. Now, by 2024, they are going to remove SIBOR rates, okay? Meaning they're not going to say anymore. I'm not going to say that 3 months SIBOR is what rate. No more publishing. At that point in time or earlier, the banks will write to the clients and say, no more SIBOR rates. Go and pick and choose what you have. So at any point in the journey, right, you see something better, our suggestion is to look at it and consider it as one of your options. Otherwise, some people will say, I should have known earlier, because then I would have looked out for the options earlier. And that's what we're saying. It's important to just keep that in mind as you're looking at your packages.
There's a question, Paul. I read it out. If the fixed rate loan is high now, does it make sense to lock in fixed loan rate or just floating rate based on 3 months SORA? So this part here, right, basically we need to look at the objective and your outlook, right, of what the market is going to be. We know interest rate is going to possibly go up even higher. But it's important to also know, right, when you choose a 3 month SORA pack home loan, right, what's the margin or the spread, right, that the bank actually charges you. So different bank has actually different spread that if you choose a lower spread, of course, every bank, if they use a 3 month SORA, right, and you have a lower spread, you are better off than from another bank that has a higher spread. So in this case, you can actually save money if if let's say you have a view that in the next 2 years the interest rate will continue to increase, right? So it's better to actually choose a lower spread for your own home loan in a sense.
Yeah.
Right.
Yeah.
So that part here, we can actually help you make sense of what are the bank's offers out there.
Yeah, the thing about this is this. A lot of people just look at the net rates. Net rates means, there's a spread, meaning a margin, plus the base rate, which is SIBOR, SORA, and then you come out at the final number, right? A lot of people just look at the final number. They say, oh, this one's same, right? X% is the same. The thing is you have to understand what is the component, how it breaks up, what the implications are, So we urge people not just look at the net rate, because end of the day, if they give you some obscure base rate, right, or reference rate, you may end up with a loan with no control. So that's what we tell people, look at the components, and then you can have a proper evaluation. Otherwise, because people will always tell you net rate more important. Yes and no, okay? Because you go on the wrong route, it's like my office is at PLQ, at Paya Lebar. If I want to go to Kembangan, I know that I can take the train, right? The train goes out this way. But if I take a bus that brings me to Punggol, to East Coast, to West Coast, and then to Kembangan, then I still reach Kembangan, right? But it kind of defeats the purpose. So it's same thing, right? Look at the objective, and then we can work out that.
Okay, just take a moment before I move on quickly. There's two questions on FHR, right? Of course, that's DBS, what do you call that, fixed deposit rate. What's the current FHR 6? Yeah, please do check with DBS Bank for the latest one. Yeah.
But yeah, I'll hazard, I'll jump in. It's 1.4%.
Okay. But of course, with the fixed deposit increasing, right, Paul, I think there's a possibility that
don't say that it will increase. We don't know.
We don't know. Yeah. I say possibility. Yeah.
Yeah. So basically, there's a fixed deposit rate for amounts below 10,000 for the 6-month period. But we cannot predict where it's going to go. Yeah. But we can give you the current rate. Okay.
Now, as what Paul has mentioned, right, it is already published that by end 2024, SIBOR will no longer be available totally. So the banks, obviously, if you're on SIBOR, they will ask you to choose another package that is available at that point in time. It may be a relevant or current market rate at that point in time, or maybe something that you may not like, in a sense, right? So it's good that we take stock right now, because it's coming to an end, right? So we can actually take stock what is available out there in the market, and perhaps there's something there that is suitable for you, whether it's fixed rate or floating rate or another hybrid package that may be suitable for you. We can actually take stock now and don't have to wait until end of 2024 to review our home loan. Actually, if you're on SIBOR.
Actually, we have a tool on our website. If you can go in and take a look, it's called Smart Refi, right? You can log in your details there, and it's like it watches out rates for you and stuff like that. I think it's quite worthwhile looking at. Just play around with it, and then you figure it out. The Smart Refi tool is something that we've built that helps our clients. So just something to put in there. Okay. Next one. Yeah.
Okay. This is something that well, I've been also advising my clients, right, that because interest rate has been rapidly increasing, it's good that we actually consider a longer tenure for this particular moment, right, where we can actually reduce our installment to tide over this challenging period, in that sense. Let me check whether there's a slide on this. Yeah, there is. So in this case study here, right, if this person with your 800,000 loan actually reduce the tenure by 10 years, right, as you can see, right, the installment actually drops significantly, what do you call that, by $1,600 a month. So this greatly, you have a savings, right, of $1,600 a month, that you can actually, during this difficult period, I know a lot of businesses are suffering and all that, and they could possibly use this cash flow for this time being while the interest rate keep on increasing. As you can see, also the cumulative interest, right, differential, it's $1,600 for a period of 2 years. Now, I'm not asking a person actually pay more interest in the long run, but we can always ask the bank, subject to the bank's approval, right, whether they can lengthen the tenure. And when we do have the funds, right, we can actually ask the bank to reduce the tenure as well. But this is something that we can consider, right? Like I mentioned earlier, if the property is investment, it's an investment property, and you wish to have cash in your pocket, right, rather than just purely meeting the obligations of the loan, the rental just nice to meet the obligation of the loan. This is something that you can actually do to reduce and the installment that you're paying, and at the same time, right, you have a forced savings for yourself as well, month to month.
Actually, when I talk to clients, right, this one a bit counterintuitive. When I talk to some clients, they struggle. They say, yeah, but you know, I'm paying more interest. You are right, right? The reality is this. If you look at I'll give you an analogy, right? You know, recently there's been a lot of good restaurants that closed down, right? Sorry, the restaurant is my thing. I like to eat. So what happened is this, right? A lot of these good restaurants are closing. And when they are asked, usually it's a question of cash flow, right? They cannot generate enough cash to sustain through this difficult period or the challenging period. Same thing like this one. So it's a question of cash flow versus interest. Personally, if I'm going through a situation, right, in terms of work and in terms of servicing my loans and all that, my priority would be surviving in terms of my day-to-day, in terms of cash flows, rather than interest. So if I'm able to generate cash flows or reduce my outgoings, right, I will be able to tide through a challenging period. So people, you know, we have helped clients who's, especially during circuit breaker, about retrenchments, you know, reduction in income and things like that. So it's not either, it's not, you know, it's a question of looking at it and say, you know, how do we use our loans to cater to your situations in life, you know? And I think it's dynamic that way. So again, this is not encouragement for people to go one way or the other, but to take it and look at it and say, based on what I need in my life, right? Based on my income, my personal circumstances, what do I need to do? In fact, some clients come and say, hey, I need cash flow, you know, and then you see interest rates going up, right? In fact, part of the strategy for these people may be to borrow more. Why? Because after the difficult period, right, after the cash flow challenges are met, it will be okay for them to repay. It's just went through this period. So, yeah, I mean, different strokes for different folks. That's what we're saying. Yeah.
Yeah, move on.
Yep. Which is the best strategy? I think we you know, I think you heard what we talked about, you know, essentially everything that we mentioned, right? Is there really a best strategy? Ben, what do you think?
When we advise our client, right, the best strategy in a sense that, yes, we do recommend options and all that, but it's always based on what our customers really need in their life, as what Paul has mentioned, right? You can be different age group, or a person may be facing some instability over their jobs and things like that, or it could be that difficult situation sometimes happens, right? And we plan accordingly to what is the objective, what's the outlook of the interest rate movement, right? Then we come up with a strategy that best suit for the person. There's no one best strategy that fits everyone.
Yeah.
And even between me and you, right, Paul, right, we probably have different strategy how we want to cater for our home loans, our expenses, because we just have different commitments in our life.
Yeah.
And home loan being the biggest commitment, right? We do need to plan for it carefully, because housing loan is a long-term commitment. And this is a crucial time for us to pick a strategy that is suitable for you and your family. It's important
Yeah.
that we discuss this.
Yeah, the danger is this. A lot of people also are very short-term minded. I think less so now. I'll say this. In the past, you would have clients saying, I don't care what happens to the interest rate in year 4. I will take the cheapest interest rate, net rate. Again, I told you about danger of doing that. But they go and take the cheapest rate, and then they say, year 4, I will refinance if the interest rate goes up. It's okay, you know, I will refinance, I'll move to another bank, I will ask for repricing, whatever. But in doing so, there are some assumptions that they take. My job will be stable, there will be no changes in my life, you know, that kind of thing, right? We have seen people being caught up. I think the biggest example was the introduction of the total debt servicing ratio, right? I think in 2013, when they introduced, people who were doing before, all of a sudden were stuck. Because in the past, banks had a lot of flexibility to help you refinance. You just have to show lump sum, you can go. Then, in the first phase of the total debt servicing ratio, where they didn't cater for owner-occupied properties, a lot of people got stuck because they become mortgage prisoners for a few years now. Until the regulators change the rules and say, okay, TDSR is there, but it doesn't apply to owner-occupied. Also, people say, oh, I can do again. But people forget. People always forget. And then they say, okay, I want to do so that first 3 years, I don't care about 4th year refinance. But so we say don't lah. I mean, end of the day, consider options, but take a step back and see whether it makes sense for you. Yeah. Yeah.
So when you take up a home loan, right, in Singapore, it's quite what do you call that? We do need to check in on our home loan packages. And for my last home loan that I took, right, I actually refinanced 3 times in a span of 10 years, capturing the best rate at each moment in time, right? So how do you start to actually make sure that your package is the right one for you, right? Now, the first step is obviously to identify what is the current rate you're paying, whether it's fixed and whether it's floating, so we can take stock of what are we paying now. A lot of people do forget how much they're paying. If I ask you, Paul, right, what's the interest rate you're paying? But you're in this job, you probably know. But you ask someone else, they won't know in that sense, right?
All right, I was about to answer you, by the way.
Now, the second one is that if you have locked in the rates for the past 2 years, right, your interest rate is possibly quite low. Congratulations, right? But as what Paul said, right, on the 3rd year, right, the interest rate will likely take a hike, right? Because you are no longer under lock-in. So do take note what is your upcoming rate. That's very important. If you wait too last minute, rates have increased a lot, right? And you'll be left over with interest rate packages that is not so attractive already. So let's look at it now. If check your letter offer, what's your 3rd year or following year's interest rate? It could be very high. Now, number 3, banks are obviously they do give different rates for different loan amount as well. So do check what is your loan amount outstanding so that we can actually help you, right, to see whether there's a better option out there. And number 4, let us know your loan tenure. Like what we mentioned earlier as well, we could possibly reduce it or lengthen it according to your current situation or objective. Yeah, and we can possibly even help you to lower down the monthly installment. There's a QR code there. Yeah, you can scan if you have any questions that you'd like to ask us on your situation.
Yeah, Ben, I think let's leave it on this screen and then let's answer the questions because with the time in mind, we have something like 7 minutes left. So let's see what we can do, okay? Let's see. I saw a question pop up a few times about whether there's a flexible type loan. Let me see. Is there a flexi loan in Singapore but from Chelsea? Whereby if you have savings account linked with mortgage, interest will charge based on mortgage loan, savings, and so on and so forth. The answer is yes, okay? There are a few banks with what we call interest offset features, meaning if you place a deposit inside your current account, I don't think technically that's a savings account, or they call it an offset account. You place money inside the offset account, the interest rate will be a certain percentage of the home loan. So if your interest rate of your home loan goes up, the percentage of the offset will remain the same, but because of the matching of the two rates, that will occur. Now, some people think, if I have lump sum matching exactly, then that loan makes most sense. The answer is no. Actually, because if you're a regular saver, the interest savings on that could help you save quite a bit. We've done quite a bit of that. But again, we are not driving products. The person, the client, should be looking at it and say what makes sense for me. Yeah, I think that's one thing. Chelsea, I hope we've answered your question, but answer is yes. The features of that we can help you with that. Just contact us. Let's look at the next one.
Number 7, I take that one. The P from Pius, is it? What's the average spread being charged above SORA rate right now? Right now, a lot of banks offer different SORA rate as well. There's 1 month, 3 month, and also 6 months SORA rate. Now the spread ranges right from bank to bank between 0.55 to even 1%. So there's a bit of a difference there depending on the bank's offering lah. And it's also dependent on the loan amount that you wish to take up. They have different spreads for that.
Yeah, it varies, but the average would be what, Ben? Just
0.65, 0.7.
Okay, so net rate is about current 2.2, 2.3.
Net rate 3% already, Paul.
Oh, okay, so net rate 3%.
305, 310, yeah.
So it's very important to understand. We look at both the components as well as the net rate, not net rate by itself. Okay. Now, somebody asked about cash flow under stress. Not advisable to use CPF to service the loan lump sum. Okay, then this is why. Very simple. Let's say my monthly installment is 3K, right? Right now, I use my monthly installment to pay, right? Sorry, my CPF balance to pay, right? Now, if I take my CPF balance to pay off partial, right? Now the loan will be reduced, right? And then the monthly installment will be reduced. But if I use up all my CPF, right, how do I service the monthly installment? Cash, right? So that is a consideration. Because in the past, my cash outflow is 0. Now, even though the monthly installment dropped, I have to pay cash, right? So yeah, again, circumstances we have to look at that. I hope it makes sense. Okay, let's look at the next one. Interest rate pegged to fixed deposit home loan versus SORA in the current economic climate. That's a good question. FHR versus SORA. I think end of the day is this. We have to recognize factually how the rates are determined. Now, the beauty of a fixed deposit rate product is this. They have to first increase the cost of their deposit before they can earn off the mortgage, right? Because the base rate is based on the deposit rate. So if I up the deposit rate that I have to pay, only then can I earn from the mortgage. Correct? So people look at it like a bodyguard. It's like the banks have a meeting, right? Talk about interest rate, right? You have a bodyguard, somebody down there protecting your home loan, because if the rates go up, then they say, hey, the mechanism takes care of you. Okay, people look like that. The disadvantage is this: you have to control the end of the day, you have no control over what rates the banks choose to charge you. Right? If they up the deposit, they up the deposit, right? They give you 30-day notice, you're bound, then you refinance or whatever, right? For SORA is determined by the market, right? Nobody can influence the interest rate except through real transactions, meaning the bank transact with each other. That's how you influence. That's real movement. Whereas the fixed deposit rate is determined by the bank, right? So which is better? I don't know. Depends on your preference. If you have confidence, some people say, yeah, this bank always pay low fixed D rate. It's okay. I'll go with that. So yeah, I think that would be the way to go. Because we meet clients who swear off, they cannot stand fixed D base rates. They cannot, some of them say, I don't like SORA. So yeah, different folks for different folks.
Correct, Paul. I mean, some people do actually prefer a fixed deposit rate because they tend to believe that it's much more stable. So yeah, like what Paul says, different people would like different strategies in their home loan. So we'll help them to make sense of it, which one is better for them.
Yeah, we've actually hit the time, but let's do 2 more questions. How about that, Ben?
Okay.
Okay. History of rate fluctuation. How do you see the rates increase will continue? My fixed term rate expires in 2023 November. Should I move to fixed or floating? So you have about over a year, no? Now, if you look at okay, so this is personal opinion, because I don't have crystal ball, right? So the thing is this, right? If you look at the interest rates that the market is placing, the yields on the curves, the charts that the market is drawing, the short-term interest rate is higher than long-term. That means that the market is expecting long-term to drop. And in any case, you will have time to look at it, right? All the way up to 3 months or 2 months, depending on your contract, all the way to September, right? I think Ben about right? September of 2023. So don't have to decide now. A lot of things will change.
Yeah, it could be possibly you're on a very good rate now, right? So of course you need to stay the distance, but maybe 4 months before your expiry, do come back and speak to us. We can share our opinion as well as the latest packages that's available.
Okay. Now, last question. Okay, sorry, we have more questions. We will try to do all these things into Q&As or articles that we will release on PropertyGuru. So go to PropertyGuru website and take a look, okay, at the content. We have a lot of information there. Okay, this one is on a lot of people's minds, Ben. So let's look at this. If the interest rate offered is high and CPF is only at 2.6%, this may make sense. What makes sense? I'm assuming doing partial payment, right?
Or using CPF.
Use CPF to pay back.
Or installment.
Yeah. I think yes, it may make sense. But the cooling measure, very interesting, right? Recently, they say inside one of the things they say for HDB loans, when HDB look at the interest rate, right? In the past, they will just use 2.6%. Now they say it's 3%, right?
The floor rate for getting a HDB loan.
That's right. So they will assume that 3%. 3%. And what is interesting is that HDB has never ever done that before. Never. And when you look at HDB interest rates, it's defined as 0.1% above 0.1% above the ordinary account.
Ordinary account.
Ordinary account is 2.5, right? Why? Because the Singapore government lends HDB at that rate, 2.5. So the margin is 0.1. Now, if you assume margin is still the same, okay? Then what they are saying is that possibly, there may be a change in CPF rates. So you look, because if CPF goes up to make up the 3, it is 2.9%, right? So possibly, and they only revise the rates 4 times a year, okay? January, April, July, and October. So we just passed October. Let's see January what happens. So you are right. If you are very far apart, that's something that could make sense, right? So we have to look at circumstances,
There's a few questions here. There's one that one that would be relevant to a lot of people. One last one, because they say where do you see 3 months SORA heading in the next 3 to 6 months?
Yeah.
So this is talking about forecast.
Yeah. Come on, we share our forecast.
Okay. Paul?
You okay, so prior to the 0.75% increase, right? We were looking at the 3-month SORA to hit 2.7, 2.8, okay, by end of the year. Beginning of or by mid of next year was 3.4, 3.5%. We've since looked at it and we say based on current circumstances, we're looking at about 3% by month year end, and 3.5 early part. We push ahead the circumstances, but again, you look at the circumstances in the US market, that appears to be changing. So we have to look at it very often. So that's currently 3 by year end, 3.4, 3.5 by early part of next year. Okay, I hope that's useful. Guys, sorry, we have so many questions we really cannot answer, but like I said, we will write out content. You don't go and read it like that, you know. There's some information in the chat box, right, about how you can contact us for consultations, for to have conversations. So please feel free to reach out to us, and I hope you enjoyed today's session. I hope you know, we've been able to handle a lot of the questions, but reach out to us and we'll have a chat. Thank you very much.
Thank you so much. Have a good day. Yeah.
Okay, bye.
Have a good weekend. Bye-bye.